Domino's Pizza stock ticker DPZ is down 12.2% year to date. Over the last year, it's down 21%, so that doesn't look that much better. And over the last month, it's down 4.6%, even though JP Morgan actually called Domino's Pizza a standout stock among restaurants. So in this video, I want to take a close look at the intrinsic value of Domino's Pizza. And to do that, we as always use our stock ticker and punch in DPZ and wait for everything to auto-populate. As you can see here, we do have everything now. Current price is $297. And as we can see here on the graph, it's down in a bit of a valley. I have received some feedback. I will try to reorganize and redesign this stock screener and also give you a little more background on the dividend data when we get to that one. The PE non-GAAP forward ratio is around 20, and that is around 25% below the 5-year average, already looking really nice. The dividend yield is 1.63%, and the payout ratio is a very low 34%, so a lot of room to grow for this. It also has a very slight amount of short interest, and the 52 weeks low is almost where we're at right now, $15 or $12 off at that point, and the 52-week high at 426. The analyst target price is 350, so they believe there are some upside in Domino's Pizza at the current time. So if we jump into the dividend data tab and zoom in a little bit, I would like to go through a little bit what I'm looking at here. So in the first row here, on the first table, what you want to call it, I want to see some steady growth from the different years, and also in these DGR, which is the dividend growth rate, which is annualized compared to the different years before that. So for example, for dividend growth rate 10 means that the 10-year growth rate is around 19.72%. So what we can see here for the dividend growth rate for the different years, 25, 24, and so on. So this is the growth rate from the previous year. And this is summarized up or annualized in a 3-year period, a 5-year period, and a 10-year period. So that is something that I'm looking a lot at. This down here is actually the average price and the average yield. So what we're using here is to combine this to calculate a little bit of discount, which we'll be using in the graph that we will go down to now. So what we see here again is that it's a very, very solid growing company, at least in terms of the dividend. They are growing at around these 10 to 20% over the last a lot of years. So when we scroll down here to the dividend data, dividend yield graphs, you can see here the 5-year dividend yield graph and also a dividend yield which looks at the dividend yield compared to the average yield. So whether or not there is some discount. So every time it goes above the line, it could indicate there is a discount to be had. And whenever it goes below, it could indicate that it is overvalued. And right now, as you can see here, it says 35%. And that is actually because it compares the current yield to the average yield. So obviously, it will move above or below, but right now it's 35% above the average yield over the last 5 years. So in that case, it could indicate there is a 30% discount or 35% discount. So that is what I'm looking for in this tab. But let's move on to the different models we do have. The first one is the dividend discounted cash flow. We take the free cash flow from the different years. We then summarize all those together to get an average growth rate. I only apply a growth rate of 8%, even though the average is 15, but I think that's very, very high, and I can't think they can sustain that for an indefinite period. So I'm thinking more conservative in terms of 8%. This growth rate is then used to project the cash flow into the future. So we have the future free cash flows. We then discount them back to a present value here, summarize all this together and the cash and cash equivalents and total debt. Combining all that together with the shares outstanding, we arrive at a fair value of $122. The dividend discount model, we do take the dividend payout from the different years. We then get a growth rate from the different years, average that together and make an applied growth rate. The weighted average cost of capital is 7.7% for Domino's Pizza. And since the growth rate for the dividend is that high compared to the weighted average cost of capital, we actually end up getting a negative intrinsic value. So in the summary, we'll end up throwing this one out, but I just want to go through what's happening in the model. Next one up is multiples valuation, where we do take some comparable companies to Domino's Pizza and having their PE average and the median of those we use to calculate a stock price based on Domino's EPS if it were just as its competitors basically. I'm thinking the Wingstop PE of 99 skews this very much higher than probably needs to be. So take a bit care there. But again, the median PE being 35 isn't that too far off the average for Domino's Pizza anyway. So I think that is pretty okay, even though actually. Next one is the price to earnings variation, where we do take the PE ratio from the different years. We then average the last 5 years together. We get an EPS from the trailing 12 months, and then we use the EPS of that, combining it with the PE ratio to get an intrinsic value of $378. Next one, Graham's Vice valuation model, where we do take the EPS of the company, the PE of a note growth company, the growth rate from the analyst, the average yield of AAA corporate bonds, and the current yield of AAA corporate bonds. So combining all those together, as you can see in the formula over here, you arrive at an intrinsic value of $223. Last one is the free cash flow valuation. Again, like the PE model, we do take the price to free cash flow ratio from the last 5 years, average that together using the free cash flow per share, which gives us an intrinsic value of $387. The last one is the Peter Lynch model, where we do take the growth rate, the yield, and the PE ratio, combine everything together according to the Peter Lynch formula, arriving at an intrinsic value of $188. Before we jump into the summary, thank you so much for watching. If you haven't done so already, please subscribe to the channel. And let's jump into the summary, where we do have all our different valuation methods bundled into this table. As mentioned earlier, we do want to exclude the dividend discount model, so we take no here. This gives us an average intrinsic value of $292. The current price being $297 gives us an average discount of minus 1.68%, meaning it's a slight overvalue. Even if we punch in a margin of safety of, let's say, 10%, we get to $263. So it's very close to being at a very fair value right now, I would say. I think this is a company that always trades a little bit of a premium, mainly due to the dividend growth streak. So if we jump back here and let's take a closer look at the 1-year table, you can see if we look maybe at the 5 years, you can actually see here that you want to go back to before 2020, back in February actually, where we did have something similar here. So there has been some opportunities to buy here basically, but I think we are at a pretty good entry point right now. If you do believe in the long-term outlook of Domino's Pizza, it offers an extremely nice dividend growth rate. So holding it for the long term, I think it would be a very okay entry point right now, if you do want to hold it long term at least. Otherwise, maybe hold out for a slight dip more. It could come, nobody knows obviously, but if you start now and then dollar cost average in on the way down, if it dips a little bit more, I think you'll be very happy in some years time. Thank you so much for watching, and I'll be seeing you in the next video.